All right, all my kitty cats out there. It is Nitty here, and welcome. This is the first video for the NittyGrittyKity YouTube page, where I'll be posting tons of educational, informational videos on charting, stock analysis, trading, etc. And for its maiden video, I really wanted to just do a broad Charting 101 video for those who may be unfamiliar with technical analysis, or TA as you might see it named. And this is also for people who are familiar with charting, showing you my broad approach and the very basics of what you should be looking at when you're analyzing a ticker to see if it's a good place to buy it, if it's a good place to sell it, if it's a good place to hang on and see what's going to happen. Now, I'm going to be doing a lot more in-depth videos on many of the various aspects discussed here, as well as some videos going over all the tools in Thinkorswim, which is what I use, and the interface, how to set up everything. But for this one, I really just want to go over the broad strokes of what I look for when I go about charting, and I don't want to get stuck too much in the weeds and have this be too long of a video. So with that being said, let's dive in. First off, I want to be very, very, very clear that I find that charting is an art form, not a science. And all it really does is it helps you to improve the probability of a trade being successful, as anything can happen to the right of the chart, okay? When you're trying to figure out what's going to happen, you'll always hear the phrase look left on the chart, and that is what happened, okay? We don't know what's going to happen. We can estimate based on prior action, prior volume, but at the end of the day, nobody has a magic 8-ball, so it's really just about improving your odds. And that's what you want to do in this game. Improve your probability, improve your odds, cut your losses quickly, and take profit on your winners. Now, that being said, a lot of these levels and things that we're going to go over are based on human psychology, essentially. And since humans are the ones who are doing the trading, even programming the algorithms that do the trading on their behalf, a lot of this stuff ends up being what I kind of term self-fulfilling prophecies. You say, well, wow, you saw it came down to that line perfectly and it bounced off it. Well, that's because, all the humans were waiting for it to do that because that's what you kind of were taught. And so it makes sense that volume came in there at that level of support. All right, so first very basic thing is, now this might not be what your Thinkorswim or your charting tool looks like, but that's not important. They're all pretty much the same. I do like to use candlesticks, which are a lot of people's preferences. You may have come standard with a line chart like that. That I find fairly useless, and we'll go into this first. So what is a candle as opposed to just a line, and why do you want to use it? Well, candles are pretty easy. We're on the daily right now. So a green candle means that price opened at the bottom right here, okay? It dipped as far as the bottom wick, and then it went as high as the top wick, and then it closed at the top of the green candle right here where it's filled in. A red candle means that price opened at the top, went as high as the top of the wick, tiny wick right there in the top, pulled down as far as the bottom of the wick, and then closed at the bottom of the red candle. So it's a way of showing where the momentum was throughout the day, where it started, where it ended, as opposed to just a line, which just shows you pretty much nothing. Now, if you zoom into smaller time periods, like an hour, for instance, you get an even closer look at what the time did. So this first hour, it opened. I'm assuming it was probably a dip right at the open, and then it ran up. That first hour closed at the top there. That's a strong first hour. So that indicated that this had some strength on that day, and sure enough, it chopped sideways a little bit, but then we did have a little pop the next morning. Now, is it possible that it opened here, went up to here about, came all the way back down, and then went up? Absolutely. So that's why the further you go in, and this right here is 1019, the further you go in, the more information you get. So, for instance, on this day, you can see it gapped up. We'll talk about gaps. Opened here, dipped a little bit, ran up here, pulled back a little bit, boom, that's your first 5 minutes. Then the next 5 minutes, opened right here, I'm going to assume dipped down a little bit there on the wick, ran all the way up to there, pulled back and closed there. So the trick is finding a balance of time frames. You don't want to make a decision based on a 1 minute candle, for instance, because a 1 minute candle is not really telling you much, okay? You would have to know what all the candles were to the right and to the left of it. You would have to know volume, and even then you're looking at a lot of fake outs. So what I like to do always is I start with the daily chart, okay? You want wide frame first. Now there is wider, you could go weekly, and for this first example, I want to use Apple, okay? I want to use a Nasdaq stock. We're going to do some OTCs later. The charting is the same pretty much no matter what, but these OTC stocks can sometimes be a little wonky when you go to chart them, just because they're more volatile. There are more things that are influencing their price moves on any given day. But Nasdaq stocks like Apple, these are nice and solid in terms of patterns that get created. There's big institutions buying these, and so it's hard for a single person or a single event to move it without everybody sort of being aware that it's going to be happening. So like Apple missing their earning estimates, for instance, that's going to make pretty much everybody want to sell the stock. So if you wanted to go super wide, you go max, you could go to the week chart, okay? And this is Apple going all the way back to 1999. So first basic sort of things beyond knowing what a candlestick is and knowing about time frames is support and resistance and trend lines, okay? Now support, resistance, and trend lines are going to be directly influenced by volume. And you'll hear me say it tons of times all across all my videos that I'm going to be doing. If I had to just choose one indicator, it would be volume, okay? Volume precedes price. Volume determines price action. You can throw your RSI, your MACD, your stochastic, you can throw it all out the window if you needed to. You could just get by with volume and price action, okay? So this is the weekly chart. Let's go ahead and grab our little trend line draw here. And just for the sake of argument, let's draw some trend lines here and some resistance support on the weekly charts going back years and years and years, okay? So I'm doing this all kind of on the fly, so we're gonna learn it as we go along. Let's say, for instance, right here, you wanted to say, okay, so this is pretty much consolidating over here, and then the move started to go up. So technically on uptrends, you're supposed to draw the line on the bottom, okay? So for instance, you could do something like that. So that upwards trend line held pretty firm for, this is a couple years, okay? Literally several years. This is 2009. This is 2016. So for 7 years, this long-term trend line was acting as support on the way up. You can nudge that a little bit like that if you want. Doesn't have to be perfect. Again, art form, not science. So how reliable was this? Pretty reliable. You could have seen this coming down to it over here, almost came down to it over there, didn't quite touch it over there, came down to it over there. But then this is when we started breaking away and Apple started changing as a company. So while upward trend line should go on the bottom and downward trend line should go on the top, we don't really have a weekly downtrend that's, well, I guess right around over here, you could say this is a little bit of a downtrend. So downtrend would be on the top like that. So the idea is that you want to change that. You want to wait for trend lines to be broken, okay? So essentially, if we can zoom in here, again, this is the weekly. This was experiencing a bit of a downtrend here for, about a year and a half, and then it broke through that downtrend over here. A little bit of a backwards retest there, but then away we went. So if you were watching this downtrend for that year and a half, when you saw this week with strong volume break out of it even, that would have been your first indication of keep an eye on this. And then when it retested, and then boom, big weekly volume right there with a big weekly candle, that would have been your, I'm going to take an entry there. And if you had taken an entry there and wrote it up as far as this little spot over there, that's almost doubling your money on Apple in about a year, which is incredible. I know OTCs, we can do that in a day or two, but on big board stocks, that is a great little gain, okay? So let's zoom back out. So like I said, upward trend lines technically should go on the bottom, downward trend lines should go on the top. That way you can see when they break above or when they break below. There is no breaking below of this trend line because Apple has been so strong for 20 years plus. But if it had broken below there, that would have been a big signal to get out of the stock, for instance. But also, you can draw upwards trend lines on the top to help see where other types of patterns and wedges are, okay? So let's say we wanted to go back to this high over there, and we wanted to draw a trend line like that, like so, okay? So you can see this is almost funneling up, okay? Funneling wider as it's getting closer to the present day over here. And now what's interesting is really, okay, this is 2007, that's our first touch point. This is 2012, our second and third touch points. This is 2015, okay? Third touch point. Over here, we're touching it all over, okay? Let's zoom in. Again, we're on the weekly chart. So it was underneath it here this whole time. It did break above it here, retested it right there, but then came back down under it over there, okay? So if you had played this breakout over here, you'd want to get out of it if it was going to break back down below it over there, for instance. Then it came back up, played around it again, right over here, another bounce off it. This is where we're really seeing a confident move up over it. But then look what this was. This was COVID, guys. This was March 2020. And when it came down for that dip, look where it literally tagged off of, like pretty much to a T, okay? You can change this a little bit, fix it over here. That's smoother over there too. And we can right click, extend to the right click, extend to the right. And so if you were, you know, getting your cash ready for the COVID crash, if you saw it coming, if you thought, oh, I think the economy is going to suffer during COVID, what spot would you be looking for? Well, if you had had your weekly trend lines drawn like this from years ago, from a decade ago, you could have literally pegged the exact pullback point, okay? And from then on, boom, it's a different chart at that point, okay? It regained all this that it lost and then some. So let's go ahead and zoom into the daily chart, okay? So let's go 2 years, 1 day. You can see here's the COVID low, boom, and then the pop. So in theory, you would say you would start your next trend line from down over here. Now, if you did that, it's kind of wonky. You know, it's sort of like, that's not really looking like a trend line. That's not really, you want at least 3 points of touching. This is only giving you 1. So what I would do for this is actually say, well, this was like a COVID recovery bonanza. So it's kind of an artificial moment in trading where things weren't naturally kind of going. So what I would do is you look for the more touch points, okay? So I might say, okay, I'm going to start this right about here on this low. And sure enough, boom, if you come across like that, you're seeing all those points of touching over there, okay? Then if you want to go to this top guy over here, boom, 3 points right over there, okay? And then you can extend these to the right as well. That way they're going into the future, so they're always there for you. And again, we're seeing this upwards price channel, and it's staying between this, okay? So if you were playing this back over here, if you saw this coming down over here and consolidating there, that would have been a good bet to say, I think it's going to go up from here. Now, it didn't break all the way up back to the top over here, came back down, and then we had another run, okay? Then it got rejected over here, didn't come quite all the way back down to it, which is a good sign, means it's building up strength. And now Apple, while it has been having a bit of a breakout lately, it hasn't quite gotten back up to this trend line on the top over there. So this isn't actually as high as you might want it to be. So we got 160 up over there. So all these things can help clue you into where price is going in the future. Could go back up over here. If Apple, for some reason, was going to take a big dump, this is the level potentially I would look for, okay? Now, you can also do things like, let's say there's kind of like an in-between line here that you could argue is, you know, sort of like that-ish. I might change it a little bit like so. So now you've got, you know, all these touches over here, on this side, up on the top over there, across the bottom over there. And now it just broke through that right there. So today, I sometimes like to do dotted lines for in-between kind of trend lines. So that's basically what you're looking at for those trend lines, okay? Now these are long-term trend lines. If you were to zoom in closer on hourly charts, half-hour charts, you could draw as many trend lines as make you happy. But in terms of figuring out, is this stock bullish? Is it bearish? What's going on with the trend? These long-term trend lines are what you want to be looking at, okay? Now, aside from trend lines, you also have resistance and support levels, okay? Those are going to be horizontal. So then we might want to say, we'll grab our little horizontal line here, and resistance and support are going to be based mostly on volume, okay? So I'm going to dive into another video later on that shows how I use volume and also the volume profile indicator to help me draw my lines of resistance and support. But for the time being, let's zoom back out to let's go 3-year one day. Okay, we don't have to see the whole thing. And as you can see, this would be a little line right there that you could argue was resistance. Okay, came up, came back down, bounced off COVID low, came up. So when it broke through this area right over there on the way up, that's a good confirmation, okay? If we zoom in even more, you'll see it broke above it, but then it pulled back a little bit. It didn't quite hit that trend line again, and that's what we want to see. We want to see old resistance become new support, okay? Some people like playing the breakout. Some people like playing the retest and the bounce because it's a confirmation. This could have done what happened over here, broke out and then pulled back. It didn't make new support out of old resistance like it did over here. So that's what we're looking for. Breakout, old resistance, new support. And sometimes it takes 2, 1, 2, 3 times to finally do that, okay? So if we're coming back to the more recent price action, okay? So pretty much when it broke through here. So now we've got something interesting going on, which is a price gap, okay? Look at this huge price gap right there. So for price gaps, I like to use my little rectangle tool here and go across like that. That's a nice little price gap right there. And price gaps are used on all sorts of charts. Nasdaq, OTC, they're also used on indices, okay? And a lot of really great traders who track indices and overall market trends use these sort of price gaps even on things like the dollar, on things like commodities. So price gaps are basically high concentrations of volume. So where did this price gap come from? Let's zoom in here. It came from this huge volume bar right here, okay? That's the biggest volume day since, let's zoom out. So this was the biggest volume day since the COVID crash, okay? So we had COVID crash, and then this biggest volume day right there, this line that's going across is average volume. So on this day, we had more than double the average volume and a huge gap up, okay? So don't think of as gaps as empty space. Think of it as the opposite. They're like black holes of volume. They're areas of such high volume that they're gonna act as support, they're gonna act as resistance. So you can see here, there's actually a second gap up there the next day, which you can sometimes see happening when there's such a huge gap up the first day. And once a gap comes back down and gets filled, I don't extend it any more to the right necessarily. You could, and it still could function as a attractor of sorts. But look at this huge gap, huge volume. So many people bought right here that this gap never filled, okay? It came down and it literally tagged it right there. So again, if you were waiting for these gaps to fill, this one would have filled. And then when you saw the bounce happening off of this one, that could have been your indication to get in. Don't wait for this huge gap to fill because there's so much volume strength here that came in. So many people bought it from here to here on this morning that they're not going to sell, okay? They're not going to, there's not any sellers below that level. So gaps don't always fill, but they are definitely always areas of interest for me. And they do oftentimes act as support without getting filled. So then we had a bounce off that, and we have never come back to that gap level. If that's going to fill, I would be very surprised considering where the price is right now. So gaps can sometimes clue you into where support and resistance is. This one is really just, a line of resistance on its own at the top of the gap there. Let's zoom in a little bit more here, and let's see if there are any more horizontal lines. So basically, you kind of just go up and down. You see where are there spots where there's multiple points of interest that the line is coming across. Now on Apple, I gotta say it's it's kind of a little choppy to an extent. There aren't really any perfect lines. You could argue, okay, right over here on this day, back over here, acted as resistance. Over here, went above it, but then pulled back below. Same thing over here, went above it, pulled back below. Resistance zone, it kept churning above it here for a little bit, but then it kept getting rejected. So you could say, okay, that's more important, maybe over there. But you see how it's not really lining up perfectly across the board, just in a few spots. So art form, not science. You could also say, okay, actually I want to move it up here where this red candle closed on the top, open on the top. This was resistance there, didn't quite get to it here, but then down over here on the right, look, new support, okay? So if you had been drawing a line from here across, you would have been very ready for this bounce over here, seeing it coming to that line. Now you could also argue that, like I said, it's not perfect down over here. You could put another one there if you really wanted to. I might do a dotted line there because it doesn't look quite as strong as support or resistance. And oftentimes it's like little areas. So between these two lines, this is where the resistance was, okay? Over here, resistance. Over here, mildly broke above it, but then pulled back down, churning in this level of resistance. Right over here, and then boom, broke through finally over there, came back, old resistance becomes support. But resistance, support, they don't have to be exact lines down to a penny. Sometimes they are, but they can be areas, okay? For over here, 138 down to 135.5 is sort of a resistance and now support zone. So the fact that it responded well off of it over there, that means I'm gonna buy over here. Now, if it had dipped down below that line, I might have waited for it to touch the dotted line, waited for a bounce on that area, okay? Now, are there any other lines of horizontal support and resistance? Let's take a look. I'm gonna go up a little higher. So right over here, that top, let's zoom in. Does this top over here correspond over here with anything? A little bit, okay? So if we draw that line right over there, you'll see it was, resistance over here on the left, and that horizontal resistance also pretty much coincided with this upward trend line that we drew before. And now over here, acted as support over here, support over here, support over here, broke down below it over here, played around a little bit, and then broke back over it over here. So definitely I would say that was a line that was worth keeping your eye on. From the left over here, just this moment would have been enough to draw this line, and it would have been on your chart for these moments of support all the way over here. Also, again, areas of confluence, okay, where multiple support lines combine, like right here. You had this horizontal support, it was holding over here, held over there, and it coincided with that middle trend line that we had drawn from way back over here, with areas over here of resistance, resistance over there, support, 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 etc., etc. So when this came down to that area, two levels right there are saying this is support. And then boom, we had a nice little move to the upside there. Again, this is Apple, so you're not going to see huge percentages. But hey, 8% in it looks like a week or two maybe. That's pretty good for a big board stock, okay? 8 to 10% is what you're getting on an index over annually. So that's sort of a quick rundown on trend lines, okay? We were looking at them on the wider time frame. Also, levels of support and resistance being horizontal based on numbers of touches. And we were looking at price gaps as well and how these things all combine to give you a clue as to where price is going to get rejected from, price is going to get supported from and rebound from. And so you want to use these levels to help you decide your entry and your exits, not just where you buy, but where you take profit, okay? If you were buying over here, let's say, on this trend line support, and then this hit over here, had a pullback, hit again, pullback, hit again, pullback. These are all daily candles. So for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, for 2 weeks straight, it could not get through this level, okay? And then it had a little fake out right there. It's like a bull trap, basically. You think it's breaking out, and then it just got pulled way back. How did we know that was going to happen? We didn't necessarily. This could have been churning consolidation in order to break out, but it wasn't. It was rejection, 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 and then breakdown. So that's why you play the chart in front of you. You use volume, you use price action to help you guess what's going to happen, essentially. But then you want to watch day of always, make decisions based on that. But as soon as this huge red daily candle came in with big volume, that to me would have been the big indication of this is not going higher here. I would have cut my losses right there, would have taken my profit, because look, we're going down about 8.5% to that next trend line. So don't think to yourself, oh, I'm just going to keep holding it. It might rebound, it might rebound, it might rebound. Why might it rebound over here? There's no support. There's nothing over here that's going to keep it propped up. It went straight from here up to there. It's going to go from there down to here, okay? And if we zoom out, you'll see that it's happened several times over here. Up and then down and then all the way up. Then when it broke out, then it made new support right there, and we're moving up. Okay, so let's move over to an OTC ticker, okay? Now, I've already drawn a bunch of trend lines on this because this is a stock that I've been watching for a while. So let's just go ahead and zoom out here. Now this is OTC, but you'll see that a lot of these same principles still hold true. So this is the daily chart. And as you can see, this is when price was first seeing some volume, from first seeing some action. Had a big daily there, had a big pullback, churned around underneath, and then boom, broke through it on a big candle with big volume, forming a little price gap over there, which has yet to ever be filled, I believe. Like I said, price gaps on the very bottom like that, where big volume created them like that, you might not always see them get filled, okay? So don't wait forever for them necessarily, but use them always as guide points. So that's low resistance. Low support now based on this price gap and this volume right over there moving up. And then, yeah, we got pulled back down. And if we extend this over to the left there, you'll see there was some support over here, support again over there, support again over here. But then look, broke through that support, okay? Dipping down, curled back up, okay? Didn't come all the way down. You might have been waiting for it to come there. But actually, if we go over to the left, you'll see there was a second price gap right over there. What did I say about price gaps? They're mass amounts of volumes. They're like black holes. They will pull the price to them. This one filled and then curled back up. You will oftentimes see them swoop underneath, curl back up. So if you're playing this, you're looking for that drop. Once this price action starts moving to the upside, you know it's not going to come back down all the way over here. This is very similar to Apple, actually, where there was a huge price gap, then a smaller price gap on top. The upper price gap filled on Apple, the bottom one did not, okay? So then it continued going up, okay? Let's look at what I was drawing over here. These were some downwards. Oh, well, first off, resistance on the top over here, very clear, okay? Then we had downward trend lines drawn on the top, okay? Broke through that trend line over there, but then continued to get rejected, okay? Then we had this other down trend line there, and then it broke through it over there again, okay? Now let's zoom in to the more recent price action, okay? So then we had another gap over here, gap up on big volume, okay? Then we had a pullback, but it did not pull all the way back down to that gap. It pulled down to this level about right here, which if we zoom out a little bit, pulled back to there, which was support over here, support over there, resistance over here, resistance over here, resistance over here. So that was sort of an interesting line to watch, okay? Then this line right below that also, support over here, resistance along this area over here, resistance over here on the more recent price action, okay, resistance. So when it popped up over it, came back, pretty much tagged this support line, old resistance becomes new support. And then what do we have? We had another gap up over here, okay, even bigger volume, okay. So then we had a little bit of a run, a little bit of a pullback. It never came down to this gap either. It just kind of coasted sideways here, holding this area just below 10 cents. 10 cents is a psychological level too, that oftentimes you will see holding for support or resistance, whole numbers, half numbers, etc. And then finally, boom, we start breaking again to the upside. We have volume increasing, another gap over there, okay? And then the next day, volume increases even more, but we don't have a huge increase in a candle. So that means that there was a little buying and selling going back and forth. You can see that by the upward wick. So if this had been mostly all buying, this candlestick would have been a lot bigger than this is, but instead you got a top wick that gets pulled down a little bit. So there was some resistance here, and look where it was, just below 20 cents. Like I said, whole numbers. So for 3 days it couldn't get over 20 cents, and then boom, finally launched over 20 cents on another increasing volume day from that 2 days previously. Next day, huge volume, bigger candle. Next day, even bigger volume, even bigger candle, even though it did have a bit of a pullback from its all-time high over there, which was around 42 cents on that day. Now, there is an incredible book that you all must read. It's all over the place on FinTwit as a PDF in lots of discords, lots of rooms. It's called Volume Price Analysis by Anna Kohling. This book changed my charting life. I'm sure it will change yours. And it basically goes into the intricacies of trying to spot various candlestick patterns and talks about how big volume, or small volume, small candle, medium volume, medium candle, big volume, big candle. That is a good sign. But like for instance over here, small volume, decent candle, same size volume, smaller candle, double volume, not quite double candle. So this is a little more tepid here. That's why it had to go sideways for a couple days. But over here we had boom, 1, 2, 3. 3 big days in a row, 3 increasing volumes. Then we had a pullback, okay? So there was a gap over there. These upward trend lines are based more on the hourly chart. So let's go ahead and zoom in to a tighter time frame with ILIS over here, okay? So if we go to 361 hour and we'll just zoom in like so, you can see on the bottom here, trend line drawn to the bottom of 1, 2, 3 moments, and then over here. So this is when we start breaking that upwards trend line. Sure enough, look what happens right after we break it, okay? Boom, big crash down, okay? Also, we had this middling kind of dotted support that was playing off of over here, playing off of over here. We had a top upward trend line that you could have argued was, actually I'm not a big fan of it being there. I would say more about there-ish, let's say. Like I said, art form, not science. And so overextended, big pullback, but it didn't break down below this upward trend line, okay? So even back here on this pullback, we're still in an upwards trend, okay? And where did it pull back to? Pulled back to this price gap that was created there. So this is the perfect price gap fill and relaunch, okay? Then we had another big gap up on this next day, okay? Big volume, big gap. So this is huge volume right here. And then sure enough, it acted as support all through here. This little wick right there, that's support. Then we're way overextended on the top of this upwards trim. This is our first indication of this is the top for now. We had a big red day getting pulled down. It did push back up a little bit, end about there. But then that's when you want to start being careful. 1, 2, 3, 4 big hour red candles in a row. Little bit of a rebound, but then 1, 2, 3 red candles. We've broken the uptrend right there, okay? We found support for just a hot second for 1 day right there on the top of that gap, but then boom, huge drop down below. And where did it drop down to? Lo and behold, back into this gap fill area, okay? Now again, it is going a little bit below it like it was over there to the left, but huge down and then recovery. What do you know, okay? It still has not filled any of the gaps way down below, but this gap seems to be very magnetic, pulling this price down to, okay? So now that we're in a downtrend, you start drawing your downtrend lines along the top of the price because now you want to wait and see when these are going to break out. So initially, this line right here was the downtrend line, okay? Slightly broke it over here for a day, but that was a false breakout, and then boom, got pulled all the way back down. Then it did confidently break through it over here, a little bit of a pullback there, but then closed there strong. That's a good sign. When you see a break of a trend line, a pullback, but then buyers come in and support that back up. As we know, that bottom wick means the price was down there, but then got pushed up to the close. That's good. It closed right at the bottom of that gap. So if you saw that price action happening this day at the end of close, you could have said, I'm going to buy it right over here, see what happens. Next day, you got a gap up. But guess what? It was not done with the downtrend. It just kind of moved the downtrend over to the right a little bit. Because now you could argue for this downtrend line, okay? Hit those lines right over there. And then it came back down, but it found support there at this next downtrend line. Again, this is an art form, not a science. So sometimes you can have 1, 2, 3 downtrend lines that you're keeping an eye on. And you can change these and move these as the price moves forward in time, depending on what price action is doing. So then when it did break this guy over here, but got rejected there at the end of the day, that's 1, 2, 3 spots. So that's enough for a trend line for me. So I drew that guy. So now this was the top downwards trend line that I'm looking for this to break. And sure enough, got rejected, got pulled back, support on this downwards trend line, sideways action, huge pull down, okay? So now we're back down into that gap. But guess what? For the first time, it dropped lower than it had in any of the other moments. Where did it end up touching? 25 cents basically to a T. And let's zoom out and see where that 25 cents lines up with to the left. Okay, so boom, look at this. Okay, we can nudge this a little bit to the top of those wicks if you wanted to. Nothing's perfect. But look at this. This is basically like a little bit of an upwards ascending triangle to an extent. Not really, because there would have, if it came up here, came down, came up here, came down. But look at the ascending action here. It was stalled below this line of 25 cents, psychological number, and then boom, 1, 2, 3. Those are those 3 huge candles that we were talking about with the big volume coming in. So where did this come back down to? To that exact moment, right before all that volume came in. So why did it bounce there? Because all these people bought it right there. So all the people who bought into this stock at 28 cents about, okay, I'm sorry, 25 cents right down here, when it came back down over here, they had the support, okay? If this had continued to drop for some reason, if 1, 2, 10 people who had a lot of shares of ILAs decided to dump this right here and it dropped below this support zone, you might have seen a much bigger dip back down to this gap perhaps. But the buyers were in control here, made sense that it bounced off of 25. And then boom, what do we have from then onwards? We have huge green candles, okay? Volume came in there on the bounce. That's when you know that's a legit bounce. Big volume on the sell side, big red candles, and then continued elevated volume on the green side, big green candles. That is a nice reversal right over there. We're on an hourly, but if you went into an even tighter time frame, let's go to the 15-minute, but we have to go back further. Do 90 days, 5 minutes. Let's see what that looked like at 25 cents, okay? So that was the 25 cents. I mean, look at this volume price action. This was a perfect cascading sort of sell-off with increasing red volume. Then we got to this perfect pre-drawn level of support. Volume stayed sustained as we had a huge recovery right there, okay? Yeah, we had a back test right there a little bit and then a continued run here. Then volume dropped off here, but price stayed up, okay? Volume, price action, analysis. That's what you're looking for. You're looking for volume and price action, okay? But this is just a perfect reversal. Ramp up on volume, huge dump in price, sustaining of volume, huge rebound in price. That's what you want to see. Very, very, very pretty. And from there, it was game time again, okay? We have this beautiful stair-stepping. Let's go back to the hourly, though. We had this beautiful sort of stair-stepping going on for several days, for a whole week. And we had new gap created over here, new gap created over here. And guess what? These gaps ended up being important again, okay? We broke up over here, but look, we came back down to the bottom of that gap, went back up, okay? Came back down to the bottom of the gap over here. Dipped a little bit below, but it's a zone. Boom. Then we got caught at the top of the gap over there, and then we got pulled back down, okay? We did get pulled back down, but look where we are, okay? This right over here found support, price held, buyers came in, have the volume down over here, you can see. Sorry, it's a little messy. I've been drawing a lot on this one, but it's a higher low than this over here. So this is a good indication. This is rebounding here. So this is the point where you say, okay, I'm not worried that this is going to keep dropping to 25 cents or back down to 28 cents. This has found a higher low now before reaching those important support levels. So I'm going for a buy, okay? Now, from that spot up to more recent highs, that's 15%. A little bit of a red today. OTCs are selling off like crazy for various reasons. This is currently October 28th, 2021, if you're watching this video in the future. So what you're watching for over here is this going to dip back down? If it dips back down, you want to see a higher low over here, okay? You don't want to see this come back down further than this area, a lower low. That would not be a good indication. You want to see this make a higher low in this area, or you want it to see just continuing to stair step up. And then where are you looking for it to move to? Okay, let's go to the 4-hour chart. So we're rebounding there. Doesn't seem to be flattening here. So maybe it is going to come back down a little bit. It'll curl. Maybe it needs to consolidate based on news catalyst, etc. Could it come back all the way back down to this gap area? It could. So I'm going to extend that gap to the right over there. It tagged it over there, for instance. But we want to see this break first these levels over here, okay? That dotted line, resistance over here, resistance over here. Did break it there, but then again, didn't quite make it there. Resistance over there. So that's a good resistance zone, resistance area around 42 cents. And so we want to see that break above here, above there, okay? Then once it breaks that resistance, it can either keep running and make it all new time highs. I'd be fine with that. Or you might see it pull back. And what do we want to see, guys? We want to see old resistance become new support. So that's what we want to see going up. And now 48 cents is the spot to break. So when we want to go to new all-time highs, that is what we're looking at. But there's a lot of wave theory that you could read into for stock trading. I don't go into it so much. I just try and trade the stock chart in front of you and play off resistance levels based on volume. But you could argue, you've got a 1, you've got a 2, you've got a 3, you've got a 4, you've got a 5. 1, 2, 3, 4, 5 wave. And so that's the completion of this cycle. Now you're looking for a new 1 going to the upside. There's all sorts of things that you can look into that can help to add to your trading, to add to your charting. So many methodologies out there. But for me, like I've been saying, like I will continue to say, it's about volume, price action, which is going to be determining where your resistance, where your support levels are, where your trend lines are. You want to look for trend lines, support, resistance to hold. You want to look for trend lines and support, resistance to become support, trend lines to be broken through. Now, aside from volume, what are some other indicators that you might want to use? Okay, let's actually hop back to Apple real fast, and let's just take a look at some basic moving averages. Okay, moving averages are quite popular. We'll go 3-year, 1 day. We still have our trend lines and our support, resistance. Now, you don't want to get too busy on any charts, with the exception maybe of if you're trading something like SPY options. I'll show you my SPY options chart in a moment. That is you're scalping intraday for 5 minutes here, a half hour there, so it's got to get busy. But when you're looking for longer term stuff, when you're looking to swing something for a couple of weeks, hold something for 6 months, you're looking for breakouts on Nasdaq stocks, etc., and even on penny stocks, you are not going to want to get too busy. Keep it simple. Don't clog it up with 27 different indicators. Find the ones that work for you and develop a plan including those, okay? Develop a set of rules of trading based on your technical analysis and follow those rules, okay? It's no use to create a whole set of rules if you're not going to follow them. Don't say, oh, this is the one time I'm going to break it, and then it ends up going to shit. You got to follow the rules all the time. That's something that I'm terrible at, so that's why I drive it home so much. I constantly break my trading rules and I'm kicking myself for it. But so let's go ahead and just grab some EMAs. We'll just do legacy EMA here. We'll add 2 of them. We'll do a 50 and we'll do a 200. There's lots of popular ones. 9, 21, 30, 50, 90, 100, 200, etc. For our case, we're just going to take a look at the 50 and the 200 right now. These are good long-term indicators to look at long-term trends. And go ahead. Yep. And now keep in mind, EMAs are different from MAs, moving averages, in that EMAs take the more recent price action more into consideration. So that's why I like using EMAs over moving averages. They can be just a little more responsive. And also, to clarify, this was something I didn't learn until kind of late in my charting career, I guess you could say, as young as that is, 4 or 5 years. I haven't been trading like a decade, 20 years like some people out there have, who I take my hats off to have stuck into the game that long. It's such a psychological battle, trading. You are sort of who you are trading against, I would argue, much more than other traders. So it's about having the proper mindset, keeping a healthy approach, psychology, all that jam. So right now we're on the daily chart. So this is showing the 50-day moving average and the 200-day moving average, okay? And if we scroll over here to the left, you can see how Apple has been responding off of it for years. This is 2004 we're looking at. So look at it kind of ride the 50 all the way up over here. It breaks down through the 50 and then boom, pretty much finds support at the 200, breaks up. So as long as you're above the 200, they say, you're pretty much still in an uptrend, you're pretty much still bullish. It did drop down below it over here for a number of days. A number of weeks really, but then it came back above it, okay? So a little bit of a bear trap, you might argue. So then look at this. We're riding again the 50 up over here, dropped below it, but we didn't quite tag the 200. We're riding above the 50 again up over here. We had a little bit of a cross down below it over here, big dip. But you get the idea. Right on this one, the 50 and the 200, you know, you're seeing a lot of moments where it's hitting, but you're seeing lots of moments where it's not exactly hitting. But right over here, for instance, this would be one of the big indicators. Your 50 is crossing below your 200, okay? That's not the price dropping below the 50 or the price dropping below the 200, but actually the 50 crossing the 200. That is a bearish move. But you see this bearish move still found support at the upper trend line resistance on the bottom. So that's a good sign at least. Same thing over here. We had a bullish cross over here, a bearish cross with the 50 crossing under the 200. So it's bearish, it's going down. You're waiting for a rebound or you're shorting it. Where are you waiting for the rebound? On that trend line. You know what trend line that is. It's the upwards trend line we drew before. Perfect bounce off of it over here. Then boom, we had the cross of the 50 above the 200. It had to kind of bounce off it a few times there, but then confidently then continue to move to the upside. Same thing over here. We had the bearish cross under, but then it tagged it, kind of got rejected, another bounce, and then boom, confident cross, bounce on the top, and then we're off to the races again. So you see how the 50 and the 200 are reacting. This now, if we fast forward a bit, we had the COVID crash over here, which, believe it or not, during the COVID crash, the 50 did not cross below the 200 on Apple. Okay, this is this is March in the market in 2020. Very surprising. But the price dropped below the 200 very quickly. That's the thing. This move happened so quickly that it didn't give the moving averages time to cross down below. And then the rebound started happening so quickly that the 50-day moving average started curling back up. And then boom, again, we were off to the races. The further the 50 moves away from the 200, you could argue the more overextended we are. So as you see this really widening out here on the moving averages, that was from this blow off top. But it's always going to be lagging, okay? All indicators are lagging, even the indicators that they claim are leading. For an indicator to be leading, it would literally have to tell you what's going to happen with the stock. And as we know, there's no such indicator. So I argue all indicators are lagging. So if you had sold as the moving average over here kind of started getting skinny, getting closer to the 200, you'd already be too late, okay? The stock already pulled down over there. That's why this started curling under. So we'll get into, in other videos, the in-depth tutorials on various indicators that you can use. But moving averages are one. And for me, you know, you could pull up the 30 and the 90. You could pull up the 9 and the 21. You could always sort of find a moving average that will confirm your bias of what you're looking for, okay? And that is, again, self-fulfilling prophecy in that humans use these things. So some stock tickers do react off of different moving averages more consistently for whatever reason, okay? Now, like I said, we're on the daily chart. This is the daily moving average. If we were to move into the hourly chart, okay, this is no longer a daily moving average, okay? This is now an hourly moving average. So the 50 moving average here is taking into consideration the 50 most recent hourly candles, okay? 200 is taking in the 200 most recent hourly candles. So you're getting a different up and down with this, okay? It's not crossing at the same areas as the daily chart would, because we are no longer looking at daily moving averages. We're looking at hourlies. If you were to go into the 15-minute chart, these are now based off of the last 50 15-minute candles, and this one would be based off of the last 200 15-minute candles. So do not think of these things as daily moving averages. They are only daily moving averages if you have them on the daily chart, okay? Now, there are things you can do, like for instance, I did a little math basically and figured out on the daily chart, on the hourly chart, how can you track the daily moving averages. So this is an hourly chart, but I actually have daily moving averages set to them, okay? If I were to move to a half-hour chart, they would no longer be daily moving averages. I did the math to figure that out. There are various indicator scripts that you can download to do that for you. I don't think mine is perfect by any means, but I always was interested to say, okay, well, I want to look at the hourly chart, but I want to look at the daily moving averages on it. So these are some clouds that you can download templates for to input the various moving averages. So I have the 50, 125, 300, 600. Those are not actually what I'm looking at, because again, I'm on an hourly chart, but these are the hourly numbers that would give you the daily moving averages on this hourly chart. So that is the long and the short of that. This also pulled up various indicators over there, okay? But let's go ahead and clear this and go back to our chart, okay? And let's just pull up 2 indicators, okay? We'll stay with Apple. And let's just go RSI. And let's go MACD, okay? These are 2 of the most popular indicators out there. I'm not gonna go into the intricacies of what they actually are. We're gonna save that for another video, okay? We're also gonna save this volume profile chart for another video. So let me go ahead and just take that off real fast. Okay, so we always want volume. Okay, volume's super important. We've also got Bollinger Bands that are on this chart now that I'd added. We'll go into Bollinger Bands eventually as well, but essentially they're based off of moving averages and then standard deviations from those moving averages. So it's mathematical algorithms that people design these things for. It's not necessarily important that you understand the mathematical algorithms. You want to understand how they're affecting and reacting to the price. So you can see here on the daily, obviously, you know, sometimes you'll say it's riding the upper Bollies, Bollinger Bands being Bollies, and then when it comes back down, look at the Bollies tightening right here, okay? Price action is moving between, and then boom, it hit the bottom of the Bollies over here. It's bouncing off the bottom of the Bollies, Bollinger Bands, and look, it happens to coincide with this level of support. So again, confluence of support. This is a great little spot right over here, actually, because you've got the 200-day moving average, okay? You also have the Bollinger Bands are bottomed out over there. You find the bottom. And you also have this red horizontal level of support. So you have support, Bollinger Bands, and a 200-day moving average all acting as support right over here. Bounced up, came back down, bounced off them again, and then we're going up again. But you're also MACD and RSI, okay? RSI is Relative Strength Index. So the basic gist of it is when you're coming down to this lower area, you are oversold. So that means the price is probably coming down and you're waiting to buy, okay? There are areas of buying, there are areas of selling. RSI, when it's getting lower to the bottom, especially when it's below 30, it's said to be very oversold. So that's when you might think about buying something. When it gets up over 70, very overbought, that's when people might think about selling, okay? But as you can see here, we were oversold and there wasn't a huge sell-off here. In fact, we can continue a slight uptrend, just going sideways, even though the RSI was dropping, you could argue. And then even here, when we dropped this big RSI drop right there, it just came back down to where it was over here. So it's not just look at this when it's up here, sell, when it's up down here, buy. There are other things to take into consideration as well. You never want to just be using one indicator unless it's just volume. If you're limited to one indicator, use volume and you could probably get by halfway decently. Then you have your MACD, which stands for Moving Average Conversions Diversions, which much like EMAs and Bollinger Bands, based off of moving averages. One of these lines is based off of moving averages. The other one is based off of an algorithm based off of those moving averages. Again, we'll go into that in a later video as well. And these are the histograms as well. And again, similar to the RSI, overbought up over here. So you might think about selling when the MACD has kind of come all the way up over here and this white line crosses below this colored line. I'm a little colorblind, so light yellow maybe. That's said to be a bearish cross. Now the MACD is trending down. The histos have flipped red, as they'll say. So that combined with the RSI cooling off down over here, that normally would indicate, again, might maybe think about selling it. But in this instance, not necessarily, because it's not really breaking this trend line over there. It's not until this area over here where RSI is dropping below 50, okay? I sometimes like to draw a little horizontal line across the 50 mark on my RSI, because you will see the 50, the middle of it being a point of support and then a point of resistance, much like over here. RSI is bouncing off that as support, finally came down below it, dropped below the support, and then boom, hit it here as resistance, okay? So when this came down here and didn't break back up through, that means we're probably having some more downside. In addition, the MACD had been trending down, and you can draw trend lines on RSI and MACDs just like you can on price. So you're waiting for this downwards MACD trend to be broken, which it was being broken right over here, okay? With the RSI, you're looking for similar things, okay? Here's the downtrend, you could say, on the RSI. And where did it get broken? It's getting broken right about here. And look, it broke it, came down, found support, found support. So these indicators are based off of price action. So of course they're gonna act and react to lines of support, resistance, trend lines, all that kind of stuff, very similarly to the price action itself. Now there's also something called diversions, which I'm not going to get into in this video. We'll save that for the indicator videos. It's one of my favorite things to look for, not just on RSI, MACD, but other indicators as well. We will go into that more in detail. There's also a great indicator called the accumulation distribution indicator, which is this white line right here. I have it overlaid on the volume. We'll have it on a separate little channel when I do the indicator videos just for that. But suffice it to say, you can't just rely on one indicator. You want to rely on a number of them. You want to look at various signals from these indicators and then make a decision based on the volume, based on the price action. But you don't, like I said, want to have 27 indicators because that's giving you too much noise. You also don't want to be relying on indicators when you're zoomed too far in. On the 1 minute chart, there is just way too many noise on all these indicators. It can be helpful if you're day scalping, day trading, just for a little bit here and there, trading for this area right over here. You could use 5, you could use 10, 15, but I'm not an expert scalper by any means. I'm trying to get into a little bit in terms of SPY options. But in terms of indicators, we'll go into them more in depth later on. I just wanted to show you sort of the basic popular ones: MACD, RSI, volume again, Bollinger Bands, moving averages, exponential moving averages. There's also TTM squeeze, stochastic, fib levels, and we will get into those in some later videos as well. But that's the long and the short of it that I wanted to go over on the basic one, okay? So just to recap, candlesticks, okay, we understand what the price action means on red and green ones. We understand what the wicks mean, where it opened, where it closed, what was the highest, what was the lowest of the candle. This is daily, so it'd be of the day. If we're on an hourly, it'd be of the hour, okay? We also talked extensively about lines of resistance, lines of support, trend lines, upward trend lines, downward trend lines, mid trend lines, the fact that it's an art form, not a science. So you don't have to be, you want to be as exact as you can with these things, but don't count yourself out just because it breaks a level by 1 penny. It might dip down a little below and then swing back up. So use them as guidelines more than hardened areas of I must buy here, I must sell here. Much like moving average crossovers, much like anything an indicator might be telling you. These are things that we are using to help us in our trading, to help us up the probability of making the right move, but they're never guarantees. Due diligence, looking into news catalysts, looking into market sentiment, all these things are other elements that will be influencing what a stock's going to do on any given day. But certainly volume, price action, support resistance, trend lines, those are all some of the major things I'm looking at, in addition to some of these popular indicators, a few other indicators that I like to use, but I don't like to stay very cluttered either. And that's basically the long and the short of it, okay? So thanks very much, guys. I hope you found this helpful. Last thing I wanted to do was just show you for fun my SPY. So these are all the lines on my SPY chart, and when you zoom into the various days, they will all make sense. At least they make sense to me, and that's sort of the important thing, is whatever sort of methodology you're developing for yourself, at least you want to be able to look at the chart. You want to be able to read the indicators and have it make sense to you in your mind. But for instance, if we just take a look at the 15-minute chart here on SPY, something very fascinating happened recently where, you know, we were underneath this level right over here, back, okay? It was resistance, resistance, resistance. We broke above it there. It It's a fake breakout though. Came back down, tapped off the top of this gap. Okay, it's very busy here, but you can still see this. Like I was saying, gaps are areas of volume support. Bounced off of that. Okay, then finally broke healthily over this level of resistance over there. Okay, and then broke this next level of resistance to the upside. Okay, and then had SPY had a huge run, a huge breakout to all-time new highs where it got pulled back. But look at this upwards trend line that it held right there, okay? Pull down below that upwards trend line. So that would be your first indication of, uh-oh, we might be going down a little bit more, which we did on this next day right over here. This was the day before today. It was yesterday. And look, where did it come down to and hit perfectly? If you want to actually guess, I will tell you, okay? But for that, we have to zoom out a little bit. Let's go to the 3-month. So our previous all-time highs were right over here at around 454. Okay, this red upper doji candle right there, which a lot of these doji candles have different, candlesticks have different names, nicknames and stuff. We can go into that in later videos too. But all-time high previously, beginning of September, was right there. Then we had the massive pullback, okay, the big dip, which came back down to about 426.36. And then we had the big run. Now 454 again was that previous all-time high right over here. More recently, we zoom into the price action. Where did this come all the way back down to and literally hit to a T? Right at that 454 level, and then we had a huge rebound up. So you can see that even on something like SPY, these long-term resistance, support levels, trend lines are holding true, okay? So if you were watching this get dumped over here the other day and you saw it hit that area and start to bounce a little bit, which I think it did in like the last couple moments, it started to bounce a little bit maybe. No, it didn't. It closed right at the bottom. But you could have said to yourself, okay, I'm going to take a calculated risk. It came all the way back down to the previous all-time highs. I'm going to play a call for this next day. A call, meaning you think the price is going to go up. Sure enough, rebounded heavily all the way back up to the top. Got rejected before being able to get back up. Now where are we right now? All the way back up to this all-time high, the more recent all-time high that we made a couple days ago. So for this, you would be watching it and saying to yourself, okay, tomorrow morning, Friday, this could either break out or this is going to come back down. And as it comes back down, believe it or not, all these lines that are drawn are somewhat levels of support resistance previously. There are some gap areas in here too, trend lines. It looks very busy to your eyes, but when I look at this, I know exactly what it looks like because I was the one drawing these things. And that's sort of the point. Can you have too many lines? Absolutely. Are you free to draw as many lines as you want? Absolutely. There's no wrong way. And by doing that, by being really obsessive with it, when you're trading intraday, when you're trying to scalp 5 minutes here, 10 minutes there, you do need to be this obsessive with it. And I just wanted to show you that as an example that even on an index, even with indices, these lines of support and resistance and trends hold true, okay? So that's it for that. I will be getting more videos out in the coming days and weeks and have some things planned for the YouTube page. So thanks everybody for watching. Hope this helped. This is Nitty signing off.